If you find yourself burdened with heavy debt, it might be tempting to imagine how great it would be if someone simply forgave that debt and whisked it away. While it's true that debt relief can free up some financial breathing room, it's not all sunshine and rainbows. In Canada, just like many other countries, debt forgiveness comes with its own set of income tax implications. Here's a comprehensive guide to understanding these implications and how they may affect your financial situation. In Canada, when a lender forgives a portion of your debt, you may be required to include the forgiven amount in your taxable income. The Canada Revenue Agency, CRA, considers this to be a taxable benefit, similar to receiving a salary or other forms of income. So, while having your debt cleared may feel great, it could lead to an unexpected tax bill. With debt forgiveness, it's essential to know which scenarios qualify as taxable income. This will help you avoid unpleasant surprises when you file your taxes. Some of the most common forms of debt forgiveness that are subject to taxation in Canada include loan forgiveness. If a lender agrees to forgive part or all of your loan, that forgiven amount is considered taxable income. Debt settlements. Settling debt involves negotiating with your creditors to pay less than the full amount you owe. Any amount that is forgiven in a settlement agreement will be taxable. Debt restructuring. If your creditor agrees to alter the terms of your loan in order to make payments more manageable, any forgiven amounts will be considered as taxable income. Keep in mind that not all forms of debt forgiveness are considered taxable income. For instance, student loans forgiven under the Repayment Assistance Plan for borrowers with a permanent disability, RAP-PD, are not considered taxable income. In some cases, debt forgiveness can also result in capital gains for tax purposes. This applies when a creditor forgives a debt you used to purchase an asset that increased in value, such as a house or investment property. The forgiven debt can be considered proceeds of disposition and may result in a capital gain, which would be subject to capital gains tax. Under the Lifelong Learning Plan, LLP, and the Home Buyers Plan, HBP, you can withdraw funds from your Registered Retirement Savings Plan, RRSP, without paying tax, as long as you repay the amount within a specified time frame. If you don't repay this amount within the specified time frame, the unpaid portion will be treated as income, which will be subject to income tax. It's important to note that the income tax implications of debt forgiveness vary depending on whether you are the debtor or the creditor. While a debtor could face tax implications for forgiven debt through both taxable income and capital gains, the creditor may claim a capital loss or business loss on their tax return depending on the case. This helps balance out the tax implications of forgiving debts in Canada's tax system. Understanding the income tax implications of debt forgiveness in Canada can be complex. Before proceeding with any debt forgiveness plans, it's essential to consult with a tax professional or a credit counselor. These professionals can provide guidance on your specific situation and help minimize any potential negative tax consequences. With the right support and information, you'll be better equipped to make informed decisions about your financial future.